Welcome everyone to this introduction to options and requirements for livestock and meat tax accounting. We're so glad you're here and joining together to learn about this important topic. I'm Leah Potterwaite. I manage education and outreach at the Quivira Coalition. The Quivira Coalition supports land stewards in regenerative land stewardship. We do this through educational programming, research, planning services, an apprenticeship program, and much more. So we definitely would love for you to check us out. And we're really happy to be joining with SWGLA today on this workshop.
Thanks, Leah. Great beginning. I want every Zoom to start with Leah from now on. So I am here representing the Southwest Grassfed Livestock Alliance. We are a nonprofit organization that's an alliance of ranchers, chefs, consumers, land stewards, conservationists, and people all over the Southwest working together to support the local grass-fed supply chain and its products and production. So we do that through original content, like today, research and gatherings, and we're really looking here to improve ecological, social, animal, and human health in our work. And this, as Leah said, this is a part of a series that we've designed together for some cold weather intellectual ruminating on really exciting and sexy topics like taxes and inventory and accounting, which I know you all love. And we're really impressed with how many of you all wanted to sign up for our classes. They are also a part of a suite of resources that we have at SWGLA, at the Southwest Grassfed Livestock Alliance. That's a pretty extensive business curriculum that we created over the course of the last few years. And we're hoping to add back in live in-person events in the future, but for now we're sort of creating just online content. So if you go to the SWGLA website, membership is free for this year as sort of in honor of COVID hardship. And all of our business resources are available to members. So that's just a couple of clicks and you will have access to all of the content that we've created, including some past classes with Poppy that cover the basics of taxes and accounting that would give you a great foundation for what we're going to dive headfirst into today. So I'm going to drop the SWGLA site into the chat as well. And I just wanted to thank everybody for joining us. And with that, I'm going to pass it over to Poppy. And Poppy, just tell us a little bit also about, who you are.
Hi, everyone. I'm Poppy Davis. I'm very glad to be here. Thank you so much for inviting me. I really appreciate being able to present to this group. I teach this kind of material all over the country through different programs, but I don't often have a chance to meet with a dedicated group that's doing livestock and meat. Here and in North Carolina are pretty much the only time I meet with dedicated livestock and meat producers. But I really enjoy it because it is it's an important topic. It's so important for the land and so important for our vision of our food system. But unfortunately, it's also at maximum complexity from the perspective of tax and accounting. Unfortunately for you, fortunately for me, I enjoy digging into it because it's important and it's important to bring the information to people. But I also don't enjoy it because I know it's unreasonably complex and unreasonably complex to expect anyone who doesn't devote hours or even years of their life to it to really fully understand. But I hope I can do a good job today of giving you enough of a framework that you can move forward with this information in a way that's practical and useful for you. So should I just go ahead? I'm going to share my screen.
Yeah, go for it. One more thing I just wanted to tell everyone, and maybe Poppy, you're about to say this, but Poppy will be pausing for your questions in a few points, but otherwise don't lose them. Jot them down on a piece of paper or feel free to jot them into the chat. A little bit easier, and Leah and I will go back to them and make sure we hit them in the appropriate moments. And then at the end of the presentation, there is obviously going to be more time for more questions. So hold on to them.
All right, so want to be really clear here. Here's the sad news. This is the basic presentation on taxation if you're doing meat production on a livestock operation. Nobody's going to think this is basic information. It's advanced and complex, but it is basic in the sense that I'm actually not giving you all the super gritty details and exceptions and planning techniques. And you know, I've simplified it as much as I can into what your options are. And I think I've given you some simple, if you only understand one thing, just understand this. But it's not basic in the sense that this is a deep dive into one topic, and the topic is inventory. So there are 2 other sessions that are recorded that you have available to you. One is an overview of how taxes work for you, big picture, the actual formula of what your tax return looks like and what each line means. And another is a deep dive on specific deductions that everybody would be taking, you know, normal things like meals and automobiles and travel expense and those kinds of things. So this is the deep dive just on the question of inventory. If you don't have a good understanding of that other stuff, it shouldn't actually prevent you from understanding this issue, just so long as you understand that this is one line on your whole tax return, right? And that you still have all those other things going on. All right, so what we're going to do today is we're going to check in with livestock accounting, but fairly quickly, because this is mostly about meat accounting, because livestock accounting basically doesn't have inventory and meat accounting does. I'm going to walk you through where that line is drawn, and then we can move forward into meat. For a lot of you, that's going to be the challenge, but you're going to see as we move through this presentation that if you want to move forward with inventory and take advantage of the great information that Olivia is going to be sharing with you next week, you really need to be able to focus on that line between livestock and meat and have some ability to separate there. Otherwise, it'll be very difficult for you to implement the inventory techniques that Olivia is going to be teaching you about. So then I'm going to sort of give you the key to understanding how inventory is calculated for tax and financial accounting purposes. And that's your big decision, is if you're going to go forward and do this or not. If you're going to follow the sort of the techniques of accounting for inventory or not, and some options for understanding how it will affect your tax return, whether you know it or not, essentially. If you go forward and adopt some of the inventory methods that are recommended, it will have tax consequences, whether you intend it to or not. So my job is to help you know that, so you can make a good choice for yourself rather than sort of make a choice just based on inventory and then find out afterwards that it had a significant tax effect. I know for many of you, your margins are small enough that the extra taxes, if you don't plan for them, can wipe out extra profits pretty quickly. So that's what I want to make sure we avoid. So that's what we're going to cover here. It is a deep technical conversation. Take home for many of you. I'm going to try, I have this short and sweet summary for you that I hope, if you get nothing else out, if you get this slide and take it to your accountant, and if you have a tax advisor, you should be able to be good for today. So livestock accounting is generally true cash basis. You expense as you go. You don't keep your livestock on your balance sheet in any form as inventory if they're held for sale. Meat inventory is separate. It's separate under the tax law. It's separate under all sorts of other law. It may be integrated in your books. Everything you hear from this point forward is going to slowly encourage you to separate it. That's just going to be the better choice for you, the more practical choice. You have other options, but if you break them down, I think most people will agree in the end, the easiest thing to do is going to be to separate the meat business entirely. The key thing to understand is that if you adopt an inventory accounting method for management purposes, which is the stuff Olivia is going to talk to you about, right? If you decide the best way to manage your business is with inventory accounting, unless you actively adopt a specific advantageous tax inventory method, the default is that the method you're using for management becomes the method you're using for tax. That's deep in the tax law to pull out what I just said, but it's there, okay? So the problem is that the default that you would adopt is very likely going to cost you more in taxes than if you actively adopted the method that's available to you that is more advantageous for taxes. So it's a critical choice, and the reason it's so critical is the IRS doesn't let you change your mind without asking permission. And the form you use to ask permission will make me cry. So I don't know what it'll do to you, but it is an unbelievably complex form. The process of asking for this change of accounting method is incredibly, incredibly complex. So it really is important to do whatever you can to get this right the first time. Now, some of you are probably already but I already did it wrong. Fair enough, and that's where I'm kind of going with the way out of that is to separate your meat accounting inventory into a new business. So everything I just said is really the take home for this whole presentation, and the rest of the presentation is essentially walking you through the details of how we come to these conclusions. Again, I really want to say you have options to plan around this, but you don't know what your options are, you can't plan, right? At the end of this webinar, you're probably not going to understand a whole lot of what I said, but you should understand enough to go get help from a tax advisor, right? You should understand enough to know that it's actionable, and that if you take action, you're going to come out in a better planning place. And also you'll have this presentation available to you, and you can take that to your tax preparer and say, whatever this says is the thing I want you to help me with, right? So I hope that's helpful in a don't freak out sort of way. All right, so a quick review of livestock held for sale. So this is cash basis accounting. You may expense all the costs associated with raising livestock in the year you incur those expenses. Now, we know that livestock is likely to stay around in your business for more than a year. The normal rule is if it's there more than a year, you got to follow special rules and you can't expense it. But in the case of livestock, you may, it's optional, expense everything. Okay. You may choose not to, right? You may choose to do some inventory method for your livestock. It's not recommended, but you may do it. It doesn't sort of violate tax practices. It's just that you're stuck with it once you do it, and you have to ask permission to change. All right. Why do you not want to keep inventory? Because it's complex and burdensome and costs you more in taxes. And the IRS has really complex rules about how you keep inventory on animals if you keep inventory on animals. So it's a rough road to go down, and it's really extremely unusual for a small producer to do it. It's really written for people that are grossing over $25 million a year, which I don't think is your problem, right? But what could be your problem is you could have already filed tax returns with some sort of an inventory accounting for your livestock. And if you have done that, then I would encourage you to seek professional help to see if it's worth fixing that method, or if it's not really, it's unfortunate, but not such a big deal that it's worth fixing. But the takeaway here is, don't take this webinar and then up and change your mind and decide that you're going to be a good manager and you're going to manage through inventory for your livestock and just start doing that. Because if you just start doing that, it will cause tax problems. All right, quick detour just to remind you, livestock that is not held for sale, i.e. breeding livestock, horses you use to work the cattle, draft animals, milking animals, those are assets like tractors or cars or fences or buildings, right? So that's not what we're talking about at all. Those are depreciated as assets. But what we're talking about is livestock that are held for sale for market. Those don't appear on your balance sheet and they don't appear on your income statement. They're essentially invisible on your books. And I can see why that's disturbing, right? Because we advocate for good management practices and we say your books should reflect everything in your operation. And the most important thing on your operations is literally invisible on your books. So I'm not going to say it's actually a great accounting practice. It's actually not, right? But because of the way our tax law works, it becomes the most expedient way to keep your records for tax purposes. And unfortunately, and I'm not saying this is good policy, but if you opt for this better management practice of inventorying your animals, you're going to end up creating such a tax headache for yourself. You'll probably wish you hadn't done it. So there you go. All your costs related to livestock are expensed in the year you spend the money. When you go to sell that livestock on your tax return, you just take in the income. There's no basis or underlying costs that you've accumulated for that animal. It's all been expensed out as you go. All right, if you seek a loan, your lender is going to make adjustments to change that. Ignore that. That has nothing to do with your books, right? Those are just your lender's adjustments. Another way people can get in real trouble on their books is their lenders clean everything up for a loan and then they try to take that information into their books. Don't do that. That's just for your lenders. But your lenders will take stock of your livestock and put that number on their sort of adjusted balance sheet for you and use that information to help decide if they're going to make you a loan. All right, so your income statement is just going to show your gross income from livestock sales, other associated revenues you can have from other programs, and your expenses for livestock purchase. So if you purchase livestock, you're just going to expense it out, right? If it's for sale, if it's for market. Other direct expenses of the livestock, you're just going to expense them out. And then all other ordinary and necessary business expenses expensed out, right? And that's your net income and loss. On the livestock side, we're going to get to meat in a minute. That's a whole other story. All right, so key terms here, because you may have heard these and you may already be a little confused by them, and Olivia will go into this in more detail next week. Cost of goods sold is the cost of what you actually sold, just like it says, right? So in farming and ranching, that's not necessarily the most important number, because the big problem in farming and ranching is you have costs of goods produced, but you didn't sell them. You either didn't sell them yet, or you didn't sell them at all because you didn't have market, right? Or you sell them at a loss because there's a drought and you have to sell everything off, right? So that's cost of production, and it's really important to maintain that distinction. Cost of goods sold is always associated with an inventory asset. And we're going to talk a little bit more about that as we get into the meat. It's important for you to have cost of goods sold if your production costs are high, if you have high packaging costs, like with berries, or if you have high processing costs, like you do with niche meat production. So you really need them both, but the problem is if you try to do them both in one accounting system, any accounting system, it's extremely complicated. That's not true. I've talked to quite a few people about this. Everybody agrees that the accounting systems that start at 100 grand can definitely give you both, right? But all the other accounting systems that are in the price range of most small businesses do a pretty bad job of doing these two things together. And the better way is to separate out two companies. Now, that doesn't mean that you have to legally incorporate two separate companies. It may mean that you just do two separate accounting companies, but one legal entity. That's fine. But time to remind you, and there is a presentation on this also recorded for you, for liability reasons, it's wise to separate anyway. It's probably when you reach the scale that inventory becomes important to you, it's probably also time for legal liability purposes to separate the meat operation from the livestock operation, just as a good business practice. All right. So here's the short version. Like I've been saying, that the best advice is to separate the two companies, but the rule is they must be separable. So the rule isn't that you have to separate them. It's that if the IRS comes a knocking, right, you have to be able to show them the livestock accounting as true livestock accounting and the meat accounting as true meat accounting, right? IRS doesn't really care how you do that, right? Just must be separable. And I'm just saying the way to do that is with two companies. All right, a quick note here, because I noticed that we have at least one enrolled tribal member and some who are educators in tribal communities. So the other really important thing to understand about meat as opposed to livestock is that for enrolled tribal members operating on trust lands that generate exempt income derived from the land, meat does not count as that exempt income derived from the land. So your full livestock operation, depending on which lands it's on, may qualify as exempt income derived from the land. But your meat operation is very, very, very unlikely to meet the criteria to qualify as exempt income derived from the land. So for a tribal producer, it becomes actually even more important to be able to separate those two, because one would be exempt and the other would be taxable. Definitely consult someone who knows about exempt income derived from the land for the tribal lands on which you operate. All right, so now we're going to meat. We're done with livestock. All that was so you won't get confused, right? Livestock, put it aside. We're talking about meat going forward. In order to get to tax, in order to understand tax, you do actually need to first understand what are called generally accepted accounting practices for inventory. Oh, wait, stop. This is the time I was supposed to stop and see if people were had good questions at this moment.
All right, so if anybody wants to drop in a question, please do so.
Probably shouldn't have much questions at this point.
Can I just ask my question verbally?
Yeah.
Okay, it's going to start typing it up, but that'll take longer. So Poppy, we have two separate businesses. One is our livestock and one is the meat business. We just did that separation last year and I'm so glad we finally did. This fall, our livestock business purchased some 6-year-old steers that we intend to raise until they're at least 2, and then we'll sell them to our meat business. But because they're not breeding stock, would we put them to depreciate? How do we treat those steers differently?
I'm sorry, yeah, so Heather, I'm sorry. That is the advanced livestock unit that I have not yet developed for you. And that is the essence. Olivia was just asking me this. She's like, oh, have you covered all the livestock stuff? No, I have not covered all the livestock stuff at all. But this is about inventory. So I'm going to have to ask you to wait on that because you can imagine that the answer is not simple. It's another scary, deep, hour-long dive.
Okay, I will wait and I look forward to it. Thank you.
But I'm glad you asked there because that applies to all the livestock producers. Is there's a whole other advanced livestock accounting, which, you know, is out there and which you probably need to know about.
Sure.
And,
All right.
and so,
So
Poppy,
again,
we're
just
not going to
focusing-
get into that in inventory next week, but I will say that the simple sort of idea that there are cattle moving through classes, which is what Heather is talking about also, you know, is something that I'm just going to say for now as a placeholder before we develop this course with Poppy, is something that can happen in a stock flow chart in Excel and really help you out. We'll just leave it there. So if you're not doing that yet, let's at least start there. So you can track your animals And then we'll get into the muck of how that affects taxes and accounting in the future.
Approved. Yes. Yes. Good. All right. So here we go.
Copy?
This is yes.
We have a couple questions in the chat that I think
Okay.
feel relevant to what you were just covering. There's a
Okay.
question on, can we not expense our animals that we use for milk, wool, or breeding? What about the feed and veterinary care for those animals?
Yeah. So that's going back to the basic tax classes. So I really don't want to go backwards into livestock. No, you can't expense those animals. They're assets to be depreciated. But that is covered in the basic tax class.
Okay. All right. And then the next question was, I think, similar to that. And I think you just answered it. So, okay.
Okay.
Thank you, Poppy.
So sorry, I don't mean to give short change to livestock. I really just wanted to put that up there so we could draw that line so we can move forward into meat, because meat is so complex and it's really going to take all the rest of the time. All right. Okay, so this is what comes underneath tax, as the foundation of tax is generally accepted accounting practices. Generally accepted accounting practices, or GAAP, the goal is to produce financial statements that reflect the economic substance of your holdings and activities. Holdings being assets that go on the balance sheet, activities being income and expense that go on the income statement. GAAP is trying to represent these things as accurately, objectively as possible. What is their economic substance? The goal is to be able to, for the financial statements to be understandable to someone with basic accounting knowledge and to be compared to other organizations. And that it can be verified by a third party who knows all the specific rules of how you decide if something reflects economic substance. Okay. The reason we start here is because it's intended to reflect reality. It's basically something you can understand. It's not, there are a million rules for all the special cases, but the simple stuff is understandable. Tax, not so much, right? Tax starts with GAAP. They start with economic reality, right? And then Congress dukes it out to decide what their crazy rules are going to be to incentivize certain things and disincentivize other things and generate revenues and spread the burden out in a way that, if not fair, is at least in accordance with what they in Congress decided was going to work, okay? So that's not based on an objective understanding of economic substance, right? That's based on essentially political deal making with some policy objectives sprinkled in, okay? So we start with GAAP. If you can understand GAAP, then you can understand tax as GAAP plus some weird rule, right? But if you don't ever understand GAAP, it's really hard to just understand the weird rules. Also, GAAP is basically, when Olivia gets talking to you next week about how and why to adopt an inventory method and to manage for inventory, everything she says is going to be stuff that the GAAP people would say, yeah, that's good. That's a good practice. You're attempting to represent reality, right? So again, I'm here to talk about taxes, which are not attempting to represent reality. It's just rules, okay? So GAAP includes this concept of materiality. And GAAP says at a certain point, don't sweat the small stuff. If an item is less than 2 or 5% of your total assets or total income, it's not worth our time as accountants to set up super elaborate processes to account for it. And that's sound judgment. Why would you pay thousands of dollars to account for hundreds of dollars worth of items? That doesn't make any sense at all, right? Small amounts of inventory, just go ahead and expense them. If there's no inventory at the end of the year, it doesn't really matter if you accounted for it during the year from a GAAP perspective, if they're only concerned with end of year. Tax doesn't do that. Tax, in this case, there are rules for materiality in tax, but for inventory, there isn't a rule for materiality. Even if your amount is small, if you're going against the IRS rules, that counts against you, and they can make you go back and do all that accounting. And absolutely, you could end up with thousands of dollars in accounting bills to correct an error that was really only worth hundreds of dollars. That's unlikely to happen because you're unlikely to be audited at that level, but it absolutely could happen. And if the IRS was auditing, particularly if they perceived, it doesn't mean it's reality, but if they perceive that what you have is a lovely quality of life, right? You live on a beautiful ranch in the country, they're jealous, they'd like to live there too. They think you're probably doing all that stuff as a tax shelter for fun. They think it's really a hobby. They'd like to ride a horse and rope a cow too, right? And they're going to come after you. You don't want to have this as an opening to have the IRS hanging out for months auditing you. All right, between GAAP and tax, if your goal is to manage for profitability, please take Olivia's class next week and manage for profitability for sure. But if your inventory is super small, if you're just starting out, if you're not ready to scale up for inventory, don't freak out about tax and go out and set up something that's completely tax compliant, even though it's for a very small inventory. You're probably better off just taking the tax hit, which is probably unlikely. But the point is, if you're scaling, if you're gonna get bigger, if you have any size of an operation where you're generating real taxable income, it's better for you to bring your inventory systems online as soon as possible while you're the smallest you're probably ever going to be, and then grow the inventory system and your capacity to manage that, grow that with your business. Because if you wait until it's big, then bringing those systems online is a huge, huge step for you to take. Very expensive, time consuming, and hard to get over that stair step, and so limiting to your growth. So really, if you plan to scale, the sooner the better to bring this online and let it scale with you. But the key thing is, warning for today, right? Budget for that and understand that there will be tax consequences. And so deal your tax person in on your decision so they can help you see the road ahead in terms of taxes. All right, so again, here's inventory accounting made simple. You need to understand this at least a little bit to go forward for the rest of today, and Olivia will go deeper into this next week. But you need to understand what goes on the balance sheet and what goes on the income statement. And I understand there may be plenty of people here today who don't right now know what goes on the balance sheet and what goes on the income statement, but that is something I would encourage you to wrap your head around in the months to come as a key management knowledge for you. Because you need to understand what goes into the inventory asset that lives on the balance sheet and what comes out of the inventory asset that goes to the income statement as cost of goods sold. To wrap your head around inventory, you have to be able to sort of mentally pretty quickly understand when a cost is on the income statement and when it's a capitalized cost on the balance sheet. Capitalized is the word we use in accounting to mean, oh no, I'm not going to put it on the income statement. Instead, it's going to go on the balance sheet. Right? That's capitalizing that cost. All right, so inventory is the asset, COGS is the expense. So your beginning inventory is the asset account on your balance sheet. And then you add direct supplies and labors. You start out, you write the check, it probably goes to your income statement, but then you move it to your balance sheet. You capitalize it into inventory rather. Plus, if you're doing it right, you allocate some of your overhead. So those are sitting in expenses, the electricity bill, the property tax bill, the insurance, it's in your income statement. And you take a small amount of that and you capitalize it by moving it to the balance sheet where it lives now with the inventory asset. Then when you sell things, you take them out of inventory, less cost of goods sold, that moves from your balance sheet to your income statement, moves in the other direction, right? So first you move things off the income statement to the balance sheet, and then you move them off the balance sheet to the income statement. So those are done with journal entries. We're not going to get into the specifics of them for a while, but I think you can see that you can't do this in your accounting system unless you have some pretty good fluency with understanding balance sheet, income statement, and journal entries for moving things. So this is the basic formula. And what you need to understand, take home from this is, if an item is in inventory at the end of the year, by definition, that means you cannot deduct that expense. Because the only things you deduct are things that are expenses on the income statement. The meaning of being on the balance sheet is you can't deduct it. That's the literal meaning, right? So if your goal is to have deductions for tax purposes, things that must be on your balance sheet are bad from the view of that goal, that very narrow goal, right? So the more you put on your balance sheet as an inventory item might be good in the sense that that's reality and it helps you manage it, but it's bad in the sense that any dollar sitting on the balance sheet can't be deducted for tax purposes. Okay. So I'm not going to go into more details for this. Some of these slides have a lot more written on them than I'm going to say, and that's so you can go back and get deeper if you want. So moving forward though, GAAP inventory methods. This is a preview of some of the stuff you're going to go into with Olivia next week, and it's also setting you up for the critical tax decisions. GAAP inventory methods are reflecting economic substance. The economic substance is, if you own the inventory, you own an asset. Assets go on the balance sheet. That's just the way accounting works, right? That's the economic substance. If you change cash for inventory, you're not poorer. You have less cash, but you have more inventory. Both of those are valuable and presumably have equal value, right? You don't have an expense until you sell that item, right? Then you have the income and the expense. Tax inventory is different. It generally follows GAAP. Yes, economic substance, we want to tax them on that. Wait, no, we don't want to tax them on that. They're small and they're broke. They can't afford not to take the deduction, right? And we want to give small businesses a break and let them take the deduction because the cash is gone. They don't have the cash to pay the tax. We should let them deduct it, even though that's going against economic substance. Right? Also, small business people may not even know what's going on, and they just may not have the capacity to manage for inventory. And so tax policy is we're not going to make them, right? So that's where tax and GAAP separate, right? GAAP simply expects you hold to this high standard. Tax starts to incorporate reality. You can't necessarily afford it. You don't necessarily understand it. All right. Here's in practice, and again, you'll get more of this later, but the overview. Your beginning inventory is your prior ending inventory based on a physical count you did. Then you add in direct supplies and labor. That's going to be a journal entry moving it from the expense account to the inventory account. Then if you're doing it really carefully, you'd add in some overhead. Then you subtract out the cost of goods sold. That's generally just going to be the mathematical number you need to solve for ending inventory. You're going to go out and do a physical count for ending inventory, and then cost of goods sold is the difference, right? Whatever you had, whatever you added, whatever's left, the difference must be what's gone, right? It is what's gone. And that's going to be what you sold, but it's also going to be what you gave away or what spoiled or whatever else is reason why it's gone. So it's not necessarily sold. All right. Units on hand. So physical count is units, right? And that's where most of you are starting, units on hand. Right? But what is the cost of the unit? That's the hard part, right? units times cost. And then when you add in the new cost layer, what is the layer of cost that you're adding? The direct supplies and labor for how many units, right? So this is the hard stuff that Olivia is going to start to walk you through, is how you associate cost with units, right? If you have people come out and work an 8-hour shift doing processing, you can determine the cost of that shift, and you can determine how many units were created in that shift, and then you do simple math to get cost per unit, right? That's where the tricky spreadsheet stuff of inventory comes about. Cost times units. Which units, which costs, right? Now it gets really tricky. FIFO is first units in, first units out. That's typically how things go, right? You create some inventory, the costs go into that inventory, you sell that same inventory with those same costs, right? You're staggered, right? So the next day you're also creating inventory and also selling inventory. And sometimes those groups of inventory are going to overlap. And that's where it gets tricky to figure out which costs go with which unit. The Lifo industry inventory method is the exact opposite of FIFO. It's the last cost in or the first cost out. That's usually not used in a meat business, but you'll hear the phrase, so I just want you to be familiar with it. But FIFO is the one that you're gonna most likely use. Even more likely, you're gonna use WAC, which is the weighted average cost. So you're just gonna take your accounting period, month, quarter, or year, average cost, total units provided, simple division, that's your cost. You don't have to be so specific that you really care that things produced on Tuesday were, some dollars more than things produced on Wednesday. Obviously, there's plenty of manufacturing operations where they do care about that, but none of you are at the scale where that's super important. All right, all of that was set up to where we get to the IRS rules, but I'm going to pause here. Mostly to say don't freak out, but we'll get to the IRS rules now that are the punchline of this presentation. You doing okay? Any questions in the chat?
None
No
so
questions
far.
right now.
Okay. All right, so that's good because when we get through these IRS rules, I think we can have more of the conversation about what this is all really driving at. All right, so there's a general rule for inventory for the IRS, which is that your method of accounting for inventory must clearly reflect income. That's GAAP, right? That makes sense. Tell the truth. That's basically what you're going to be taxed on. Prior to the 2017 Tax Act, this was way worse for all of you. There was no exception. There was no mercy. Everybody with any inventory at all had to have a formal inventory method, and they had to put all their direct costs to inventory, and they were required to allocate a percentage of overhead to inventory. Tax rules for that were under Code Section 263A, and they were a whole other chapter, a whole other presentation on how you were required to allocate overhead. So it's just a given that most small businesses prior to the 2017 rule were out of compliance with the tax requirements for inventory, which is part of why it got changed in 2017, because it was too complicated for anyone to understand. So as bad as you might find today's presentation, I swear to you that what I'm presenting today is a million times simpler than how it used to be. They actually signed the 2017 Tax Act into law on my birthday, and I was staring at it, and I really didn't know whether to laugh or cry because it blew up like, years worth of work that I had done to explain the old tax rule. But on the other hand, it was good because now I have this new presentation, which is so much simpler, as you are seeing. Okay, so the post 2017 rule is if you're under 25 million, you may elect one of 3 allowable inventory methods. None of these methods are GAAP. Well, they may include GAAP, but the specific names of these methods are not GAAP names. They're tax made up methods. So there's your simplification. You still have to go down into the bowels of the tax code to know that there's this election out there for you to make. And then you have to go and figure out what your options are and which one you would choose. So what is an election? What does it mean when the IRS says you may elect? Sometimes they have default elections. They're automatic. You make it without knowing it. And that's for people who don't know, right? And they say, oh, you don't know, we've chosen for you. And then the options are for people who have the ability to go get professional help and make a choice. I just have to editorialize that that doesn't seem very fair to me, but that's the way it is, right? So it clearly is to the advantage of people who can get professional help in making the best choice. But otherwise, you are defaulted to just the default choice. If you file your tax return for 2 years in a row using the same accounting method, that's what you've elected. Those 2 years equal, you've decided that's your accounting method. Then you cannot change your accounting method without formally requesting IRS consent on a form which will make you cry. It's just an impossible form, even for a trained person to fill out. So you really want to avoid having to formally request IRS consent for a change of accounting method. For years, I thought that couldn't be right. Like, how hard could it be to just ask for permission? And then I'd try to fill out the form. Like, okay, this is why we never, ever, ever want to have clients that need to ask for permission. All right. So there you go. If you file for 2 years, you've elected your method, but it may be wrong in some ways, not allowed by IRS. So just because they haven't granted you permission to change doesn't mean they're not going to make you change. Understand the difference, right? They might make you change. And you may be overpaying taxes, which isn't good for you, or you may be underpaying, which is why they would make you change. Right? All right, so because the 2017 Tax Act allowed this massive change of inventory method, and everybody wanted to change their accounting method, they said, okay, we'll give you an automatic way to change your accounting method. And I looked that up and that's not good. The automatic method is still 5 pages of instructions and incredibly complex, but it is simpler than the other one. And so if you're taking all this in and you're realizing you've been keeping some inventory, you've been filing, you've probably been doing it wrong, now is a really good time to see a CPA and get your method changed. Go ahead and file that horrific form, ask for permission to change your method under these automatic method change methods. It's the easiest out you've got for a while to fix how you've been doing it. Or start a new business, which someone who asked the question earlier mentioned that they had just recently done this. Would be maybe a great topic for another seminar one day with this group, is just, you know, how you go about separating those businesses if you've decided it's time to do it. But it gets you away from this problem of having done inventory some way that's not quite right or desirable. You just separate out the meat business. Now the meat business is filing new tax returns and you do them the right way, and that's the method you elect, and you lose the historic problem, right? A few years, you know, it's still buried a little bit in your old business, but once you're 3 years clear, you don't really have to worry about the IRS going back and auditing, and you're able to move forward with a system that you've designed deliberately. All right, so here's your 3 methods that you can elect. You get to choose one of these. Okay? The first one is this new inventory method called NIMS. I keep trying to come up with a Miss Frisbee and the rest of NIMS joke, but I don't have one. I guess a prize to someone who does. I had a picture of a cattle herd with like rats and a Miss Frisbee or something, but anyway. All right, so the NIMS inventory method, we're gonna talk about that. Then there's these other 2 methods, which are super obscure, but I'm gonna walk you through them, and they're important to know. It's what makes this all so brilliantly complicated. All right, the AFS inventory and non-AFS inventory. So NIMS is where most of you should land when you make a choice and do it the right way. Is the simplest, not necessarily the most accurate, not necessarily the most advantageous, but overall, probably where a lot of you are going to go, and for a reason, right? AFS inventory is an alternative financial statement inventory. It's basically GAAP. It means a CPA has prepared financial statements to GAAP standards, and you're filing your taxes on those GAAP basis of your financial statements. So there's no difference between your audited financial statements and your tax basis. It's completely rational, it's completely transparent, it's good accounting. It's simpler for large companies that are doing it that way, but it's not tax advantageous for a small producer like you. It costs you more money in taxes. It's harder on your cash flow. So then we have non-AFS inventory, which is just a strange beast, because it somewhat says you can do whatever you want, and it leaves it up to you to figure out how to do that the right way. They put very few rails on it. It's what's most likely to go wrong, right? You can't really do whatever you want. There's a gotcha in there, and you can end up in audit problems, and there's going to be a lot of audit problems coming out of people trying to do this non-AFS method. But if you follow closely, this is what's brilliant and perverse about it. It allows you to claim complete ignorance and keep no inventory at all and keep the simplest books possible on the assumption that you know nothing and don't keep any records and couldn't possibly understand all this, right? But to understand that that's okay, you have to understand all of this. So it's kind of backwards. But it does essentially create a legal out for no inventory at all, even though you have inventory, right? It creates a legal out for you to not report any inventory on your tax return. So this is heavy stuff. How are we on time?
Doing good. We have a half hour.
Okay.
But I don't know how many slides you have. I think we're doing good.
So I'm going to walk you through these other methods a little bit fast because I don't want you to try to understand them very much, okay? These slides are here so you can take them to your accountant if you need to, or if you really want to nerd out and read them, but we're not going to read them today. AFS method means audited financial statements and some additional financial statements. I just want to highlight here, some of you may or may not understand these words. If you understand these words, they may be relevant. If you file for what's called WFAR crop insurance, whole farm adjusted revenue crop insurance, or a farm service agency loan, or a value-added producer grant, you may have an alternative financial statement, and you may choose to follow this method. It may work for you. Make that decision with your tax preparer. Your tax preparer knows most of this, but what your tax preparer may not know is what's at the bottom of this slide with the double stars, that you may have something that qualifies as an AFS, even though you're not being audited. Anyone who didn't understand that slide, just ignore it and keep going. Okay. Non-AFS methods. This is the stuff that really is the trick here for you. If you think you want to keep it as simple as possible and still be legally compliant with the IRS, this is your narrow little way to thread that needle. The rule is that you have to have books and records that properly reflect your business activities for non-tax purposes. So for management purposes, right? You have to have books and records for management purposes, and that's the basis of your tax return. That's what I'm saying. If you don't know what's going on and you start doing it, that becomes your method. You've elected this non-AFS method, and you're filing taxes on whatever basis you're using for managing your business. And likely that means there are more costs in your inventory asset than are ideal, and you're going to be paying a little bit more in taxes than is ideal. How does the IRS define books and records? Your general ledger and all the associated subledgers, translation, all your QuickBooks, all your Sage Accounting, whatever your accounting software is, all of it. That's the general ledger and associated subledgers. Work papers supporting any of those balances. So bank reconciliation, any Excel spreadsheet, anything that connects to that accounting system is included. If you have records that aren't a double entry bookkeeping system, so you're just writing your checks in a check register, you're just keeping records on Excel or Square, that counts. It's not double entry bookkeeping, but they'll count that. And then any work papers that are, this is the key, any work papers used in management but not reflected in the general ledger. So that is physical inventory count if you're also calculating costs. The second you do any kind of record keeping where you count what you got and you do anything to apply cost on it, which is what Olivia is going to be talking about next week, right? The second you do that, those records become part of this non-AFS methods books and records. And unless you elect differently, you're supposed to be paying taxes on that basis, right? So unless you're tracking it in your head, you put it on paper, you're either going to use the non-AFS method or you're going to elect NIMS, which is what I'm going to talk to you about in a second. All right. Okay, this slide again, super complicated, but what it gets down to is, this is the hidden part. If you don't write anything down, if you are strictly cash basis, if you don't manage your inventory at all, then you don't have to keep any inventory at all on your tax return, and you can report your inventory on a pure cash basis. People who have substantial, valuable inventory, but still less than 25 million gross, who are somehow miraculously able to do this, can save a lot of money on taxes. But it's super unlikely that you can actually manage your business profitably and not write anything down and be legitimately all cash. But for some of you, this may work, right? Some of you may still be small enough that it's what you're doing and you're not ready to scale up. And so for you, I want to say, like, if none of this is making sense and you don't want it to, and you don't want to create an inventory system and you don't want to scale up, keep it simple, keep doing what you're doing. True cash basis taxpayer, no inventory, no tax problem, but know that you can't wake up one morning and decide you're going to go start keeping inventory and writing it all down. When you do that, then you'll come into this conflict between the way you're reporting on your tax return and what you're doing in reality. So when you go to do that, consult a tax planner. That's what I'm saying, okay? So if you report quantities only, no dollars, just quantities, you're okay. It's when you associate the quantities and the dollars together that the problem starts. All right, so this is what I've been saying. Is this a good thing? No, it's not really a good thing, okay? It's good that you have options, but it's kind of unfair because the only people that understand the options are the ones who can afford to pay to have someone explain them to them. Is it good for you? Is it good for you to not keep inventory in order to reduce your taxes? No, probably not, because if you don't keep inventory, you're super unlikely to be profitable and sustainable. So probably better to pay a little bit more in taxes and not do all the shenanigans to avoid the taxes, but also shoot yourself in the foot and have a non-profitable operation. So just some warning, right? Just because you can doesn't mean you should. And also a warning, if you go to seek advice from a tax preparer, which I keep encouraging you to do, right? Problem is, tax preparers tend to just really want to minimize taxes. It's like what they do, right? And they may just come out of the gate like, oh, this is fabulous. Just don't write anything down and you can deduct it all and it'll be good. But they're not really thinking about the long-term sustainability of your business. They're just thinking like narrow right then. They're like super excited. They're going to get you great tax deduction that year, right? So you have to be able to go to your tax preparer and have the conversation and say, look, I don't want to pay more taxes than I owe, but what I really want to do is manage my business to be profitable for the long run, to be sustainable for the long run. And of course, I'm going to pay my fair share of taxes as I go. So can we do that? And then you're going to end up at NIMS. Okay, so here we are at NIMS. Non-incidental materials and supplies, NIMS, totally made up thing. What you do in NIMS, so this is an election, okay? If you elect NIMS, you can do whatever you want for real in your management system. You can capitalize a whole ton of costs through inventory for management purposes. But for tax purposes, because you elect NIMS, you can take the bigger deduction on your tax return, okay? So in NIMS, you capitalize your direct costs, but you're not required to capitalize labor. And labor is where most of your cost is, right? So for sure, for real management purposes, if you don't capitalize labor, you have no idea why bother, right? You don't know how much labor went into your product. Why are you doing inventory at all, right? But for tax purposes, you don't have to capitalize labor. So you're only going to expense the cost of the purchases, and that's going to be the cost of the carcass that you purchase from the ranch, right? That's how that comes back around, right? So you're going to purchase the carcass from the ranch, zero out the ranch tax return basically to zero. The ranch sells it to you at cost. Ranch is now zero. Meat inventory now has this inventory cost of the carcass. Cost to produce it into meat doesn't count for tax purposes because you don't have to capitalize labor. And then you expense out following the basic inventory formula. When you sell the product, you may take the expense. Right? So you expense as you go from that point. All right, I know most of you didn't follow that. What you needed to follow was your tax planner to get this straight, but probably if you want to have good inventory management method for management purposes, for tax purposes, you're going to want to elect NIMS to give you a tax return that is a little bit different and a little bit more advantageous than your internal management financial statements. There's some details here we don't need to go into, but there are some subtle disadvantages to NIMS that for those of you that are really operating in close concert with your CPA and getting that advice and doing detailed tax planning, there may be some reasons why you would elect a different system besides NIMS. So I'm going to skip over this, but there are some downsides to NIMS that would cause people to elect another non-AFS method where they're still keeping inventory, but they're not quite following NIMS. The key thing on NIMS is that you can expense when it's used or consumed, and for normal human purposes, that means sold. There's some details in the rules I won't go into, but basically you can expense when it's sold, which is what most inventory systems do. Yep. All right, last section. I'm not going to take questions here. I'm going to go into this last section and then we'll have the whole rest of our time for questions. So this is the part I'm trying to impress upon you, like it's so easy to get it wrong and then so hard to fix. So it's really important to try to get it right on the front end. You adopt a method of accounting when you file 2 tax returns. Once you've adopted the method, you can't change it without asking permission. I've said this 3 times, but it's because it's so important. You have 2 years. There's some rules about when you can go back and amend. So if you've only filed 1 year and you realize now taking this that you really want to change, you can amend that first year to change it. Again, CPA territory, right? Like, don't do this based on what I'm saying. This is all like, take this to your CPA to get it straightened out. You file the Form 3115 to do it. The rules are deeply complex and you're gonna need a CPA to fill that form out for you. But it may be worth it at this point on the front end to just get it all straightened out and move forward with confidence. Like I'd said before, the better plan is probably, if you're gonna go down this route, if you're gonna take inventory seriously, which I hope you will, and Olivia's gonna give you a whole nother pitch on why this is so important next week, it's time to separate the businesses. You're gonna keep coming back to this decision over and over again until you do it, unless you're just planning on staying super small. So the ranching business is going to remain a cash basis business and it's going to report on Schedule F. The meat business is going to become a new business and it's going to file its first tax returns correctly, and it's not going to report on Schedule F because it's not farming or ranching. It's going to report non-agricultural income. This is correct. I mean, if you're already reporting meat income in with livestock income, you've already got a few other little problems that aren't tax problems, but you're basically over-reporting your agricultural income, which can get you in other kinds of problems with other programs. When you've separated and you set up this new meat business, it's going to use the inventory accounting method that it elects by filing its first two tax returns. That's how you make the election. So the first two tax returns you file on that meat business are critical because that's what sets your method for the rest of that business's life unless you request permission. And that's why I'm giving you this whole song and dance to convince you how important this decision is. Right? So the ranch is going to be selling the live animals or the whole carcasses to the meat business. The meat business is going to take that whole carcass into inventory, raw material supplies. And at that point, I hand it over to Olivia and she talks you through how you add the cost layers to those raw material supplies. All right. So the last question here is getting into this cost basis business. If you've done this, you've separated it, you have this new meat business. Is it one sales transaction at the end of the year? This is the simplest way you could do it, right? One sales transaction, however many animals you sold during the year is one sales. The ranch has all the costs for that year, all the expenses, and they say we're selling all the animals that we sold during the year equal to all our expenses for the year. So the ranch is just zero. The Schedule F is filed, but income minus expense equals zero exactly. So now the F is just zero. Everything else is over on either the Schedule C or whatever form it's going to be for the new meat entity. That's great. You're good for tax purposes. For management purposes, you don't have the information you need to keep detailed inventory during the year. All you can do in this system is sort of an average cost and average expense, which may be fine. But if you want more detailed inventory records, you're going to need to be tracking multiple sales transactions from the ranch into the meat business so that you can track inventory more closely on the basis of months or quarters rather than for the whole year. So that would be a true accounting. And this is where you would probably need to elect NIMs for tax purposes, but maintain the GAAP type books. Or if you're more sophisticated, you could find something in between with the help of a CPA. All right, so we pretty much made it through. I hope everybody's still alive. I'm scheduled to come back for a second session on this. And on that second session, we're not going to cover new materials. It's essentially going to be like an extended Q&A on what we just covered, but incorporating back what Olivia is going to cover. And it's really going to be more like workshopping, like what does this mean for me, right? Taking Olivia's information plus what you just learned, putting them together, how does that translate into actions for you? And we'll give you some templates for journal entries, but that's about it for new material. It's just going to be the discussion and application. But we still have some time today for whatever questions and discussion till the end of this session. I apologize if your brain hurts.
So Poppy, we've
Where
got
does one
one
elect
question here. Yeah, I see
You
that.
elect NIMS. I see this. Where do you elect NIMS? You elect NIMS by using the NIMS method for 2 years on your tax return. You elect a non-AFS method by not knowing what you're doing and filing tax returns for 2 years and not knowing. You've elected the non-AFS method.
I think everybody's brains do hurt probably. Everybody's like swimming a little bit.
I'm so sorry. I'm so
No, it's
sorry.
good. It's a lot.
I can't hide the truth from you. This is how it is.
Okay, here's one more. We don't have our animals processed USDA. We have them processed custom exempt. So we don't have meat inventory per se. We sell the live animal to our customer for processing. How does this impact our inventory? Great question.
You sell the live. Who pays for processing?
The customer in custom exempt.
Yeah, I mean, if that's really what's happening, then that's really what's happening. The reason I'm making all these faces is there's so many legal issues with that. There's so many questions about if that would really stand up.
Well, I can hop in
here.
I can hop in here with that. That is the legal way to custom exempt process, is the customer has to pay the processing directly to the butcher in order for you to legally sell that meat. You have legally, as a rancher or farmer, sold the live animal, a share of the live animal or the whole live animal to a customer. They have obtained ownership of that animal before it goes to slaughter. So she is correct in that legal process.
Then you've sold it, right? I mean, that's if title truly transfers. If title truly transfers, right?
Right.
And that's where I have the questions is like, you know, there's a million ways to argue that title didn't truly transfer. But if title truly transfers, then you sold the animal, you're done. You're a livestock producer, all is good. You sold the animal.
Y'all didn't know that Poppy is also has a JD. And so she put on her attorney hat right there for a minute.
See, the fact that you're asking me the question is why I make all the funny faces, right? Because the fact you're asking me the question sort of implies you touched it again.
Well, so I think the response there is that there's a lot of back and forth between ranchers who sell custom exempt, right? And negotiate what that end product is like for them, even though there is a transactional invoice that happens prior to the sale of the animal, right? And so I often come in contact with folks that are futzing with all those middle steps, right? So the advice is make sure you're doing it above board so that you're selling that live or live share of the animal with the proof of an invoice before the animal moves off the property, and that the customer is paying the processor and picking up the meat. If y'all want a revisit of this, we've got a really great online webinar from last year's Regenerate conference, thanks to Quivira. It's long and it covers supply chain. But I think the answer, Poppy, is that in that instance, you're right. You don't have inventory. You've expensed the feed to raise the thing, and you brought in the revenue in this.
And you're good.
A year later, or 2 years later, 24 months later, whatever, and you're good.
Yeah, it's livestock. That's a pure livestock operation, and that's why people want to do it that way, right? I mean, that's why all that exists, is because people are trying to end their operation at the end of livestock and not get into meat. For and all the obvious reasons, like meat is
George
hard.
added in the comments that that's a non-USDA harvest, and that's correct for just so everybody's following. A custom exempt is a non-USDA certified harvest, non-USDA certified processor, butcher.
I would still I have to say, if you're doing that, I really, really, really would hope you would check in with a qualified attorney in your area and just ask them to also review with you what you're doing and believe that it is legally compliant in your state. I'm obligated to say that. So that's why I said it.
I'm obligated to also say, don't put it all over your website that they pay you for the butchery services. Don't put it in your marketing materials. They are paying the butcher, ideally. If they're not doing that and they're paying you, don't tell us about it. And also, this is only, this doesn't apply to non-amenable species. So this is only amenable species, just to clarify. Okay, we've got another question.
What else
I
you
sell
got?
whole live animals, but charge by the carcass weight after slaughter. I take animals to the processors. My customers pay all slaughter and processing fees. Good to go.
Okay. Right. Yep. Where are we up to? Are we up to Cindy's question? Cindy has an interesting question about raw wool, processed pelts, skulls, and processed wool. No, none of those things are value-added inventory. All of those things are still raw agricultural products. So you are still a livestock producer with respect to raw wool. I'm going to go ahead and say processed pelts unless you're keeping them as real inventory, right?
I was going to say, what about wool, Poppy? I answered the opposite to her question in the chat because of wool.
She says raw wool. Says raw wool.
Processed
not
pelts?
Spun, not dyed, raw wool.
Right.
Raw wool in bulk, right?
But then she says processed wool. But she says processed wool.
Processed wool is different, right? And the processed pelts, I'm going to say, is like on that line, right? Basic processing necessary to bring a product to market is part of livestock, right? You can't hand someone the disgusting raw pelts, right? You have to process it enough that it's safe to transfer, right?
Mm-hmm.
So that's still a raw agricultural commodity. You have not yet cut it and made it into the leather purse, which is clearly not an agricultural commodity. There's a little bit of wiggle room there on the pelts. If you have, one of the key things on inventory is how much do you have hanging around at the end of the year, right? Because we're talking about, can you deduct your expenses or not? If you already sold them, it doesn't matter that were technically inventory. They're not in inventory at the end of the year. You don't have a problem. But pelts sometimes move slowly. So if the reality is that you've got $10,000 worth of pelts and that's material for you, right? Then that may be inventory in that case. But if the reality is you only have a few and you sell them out mostly through the year, then I would just treat it as a raw agricultural commodity and call it all livestock and not value added.
Okay.
But yes, everything we said for meat, substitute processed fiber
product,
and you get the exact same result.
And so that would go for also, my guess is the line would be salted versus tanned hides. But Alex makes a comment that says, Cindy, per our USDA compliance officer, that is legal in New Mexico. So then we enter into the
legal
state.
USDA legal and IRS, there's no relationship there whatsoever, none.
Right. So let's not get too far down the
at all.
Supply chain problems.
USDA people do not know tax. There's like 6 people at the entire USDA who know tax. I know that because I know them all, and we had a club. Not making that up. Okay, so don't go to the USDA for tax advice.
So Alex, no, not Alex, sorry. Soul Ranch is asking, where can we find more info about sales tax for each state on live sales, custom exempt or livestock? So custom exempt meat or livestock live, I guess, versus meat sales USDA inspected. I guess that's all the options.
Sales tax is state. So, I mean, all your state sales tax authorities will have websites on sales tax. And so, yes, to clarify, sales tax was not the subject of this presentation and
Yeah.
a completely separate issue. This is
So
just federal income tax.
Yeah. Okay. And Tommy shouts out that
State income tax will generally follow federal income tax, but sales tax is not an income tax. It's a different kind of tax altogether.
Sure. All right, yeah, we have 3 more minutes, but we also have a session in 2 more weeks. So don't feel the pressure. I think it'd be great if you guys wanted to go revisit what's ruminating around in your brain and come prepared to Poppy's second half to dive in as well. But we do have a few more minutes. Olivia, will your presentation next week use a particular software like QuickBooks? Good question. No, we're going to be keeping it really high level and touch on operations and multiple systems. We are going to be referring to QuickBooks just because it's sort of the most common accounting software platform. We're also going to be talking about how you make the evaluation to move into an inventory system platform, and how you make the evaluation that you don't want to do that and you want to stay in accounting platform and Excel potentially, or accounting platform and piece of paper. Especially after hearing Poppy's presentation, and if I want to put anything in a computer.
Well, no, but the piece of paper counts.
Right, as a work
There's no way, if it's in any form besides your photographic memory,
got it.
It counts for IRS purposes.
But we are going to touch on what happens. We're not going to go super deep, but we are going to touch on what happens in your accounting to move things from a live animal into meat. But we're going to keep really high level because I know that most of you are really at the beginning stages of thinking about this. And we're going to also talk about literally all the operations involved, like coolers and temperature and counting and people. So we're trying to touch on the high end of accounting and reinforce some of the understanding of what is a ranch business and what is a meat business, and introduce the ideas of how that can play in a specific transfer. But I think that Poppy's general journal entry templates in 2 weeks are going to help you actually do those transactions. And we're going to also talk about, what do I do with my farmer's market person? Like, how do I tell them to deal with my inventory? What's the tools that I'm going to give them? I got a POS system. What's that about? So nuts and bolts, like involving humans. That's kind of what we're going to get into. And potentially, like, when do I know that I need a more robust, more expensive system? So that, just as a reminder, is Wednesday, same time, same Zoom, with me and my colleague Miriam from Bernoulli Finance, who is the inventory system guru. So between Poppy and Miriam, I just kind of float in the ether, connecting the dots, and these two are the real experts. And Leah just dropped into the chat links for registering. Well, we're at the top of the hour. Leah, what do you think? You want to drop the gavel here?
Yeah, thanks so much.
I want to hear, before you go, I want to know if anyone's brain has truly exploded and if anyone is in need of aid.
I think mine has, but in a good way. So thank you. And yeah, please share in the chat any thoughts or feelings y'all have. Really appreciate you, Poppy, for sharing all that. That is some deep information, and we need help in these spaces. So thank you. And Olivia for organizing, and all of you for showing up and, entering.
So impressive. Thanks for sticking with us, y'all.
Yeah. Thank you.
So notice the small change in the title here, right? The official title says tax accounting methods, but what it really is tax and accounting methods. And that's what we're going to talk about, because you really have to make a double choice. You have to pick your tax method and you have to pick your accounting method. And Miriam and Olivia were talking about that last week, whether or not or how or to what degree you integrate your inventory, physical inventory methods with your books. So that's what I'm going to talk about, is set up sort of a few different options for what you're going to choose as you go forward with inventory. So the first thing to understand in framing this, and this is what gets missed a lot and confuses people and makes it difficult, but it's not actually difficult. There's 3 types of accounting, right? And a lot of people don't think that. They just think there's accounting, but there isn't accounting. There's 3 very distinct branches of accounting. And inventory is one of the rare times when you really have to be able to understand those 3 types and use them together and have a plan for how those 3 types are going to intersect. And sometimes when I say there's 3 types of accounting, people say, you know, are you saying I'm supposed to keep 2 sets of books? I heard that was deeply illegal and why you go to jail, right? So yeah, no, don't keep 2 sets of books. That is bad. That when you say 2 sets of books, you mean fraud. But when you say tax accounting, financial accounting, and managerial accounting, you're speaking the language of accounting and you're specifying what your goals are and what guidelines you're following, okay? So tax accounting, that's not optional. Congress wrote that for you. They wrote it to the IRS implements. You just play along. It's very important, but it's also important that the tax tail doesn't wag the business dog, right? So you're a business, you want to plan for taxes, but if the only thing you're planning for is minimizing taxes, that can't possibly be a good business, because the tax code isn't written to encourage you to do that. People do that all the time, but it's not the formula for good business. Okay, financial accounting. Formal financial accounting is CPA prepared financial statements by definition. What it means to be a certified public accountant is you have a license that says that you may attest that financial statements are prepared in a certain way. Okay? Everything else is like close to that. And that's where your books are going to land. We'll talk about that some more. But for most of you, if you're not required to have CPA prepared financial statements, then under financial accounting, you just have your bookkeeping system, and you actually have a lot of latitude about how you keep your books. And we'll talk about what that means for you, okay? Basically, what it means is you don't need to get an A+ in accounting to run your business, right? If you're not required to have CPA prepared financial statements, there's a lot of fancy formal things that you don't need to do in your books. And then finally, we have managerial accounting, and that's really where inventory lives. And part of what we want to talk about today is the degree to which you're going to choose to integrate your managerial accounting, your inventory accounting methods into your regular bookkeeping system, into your books, into your daily financial operations. And the answer is you have choices, you have options, and each of your choices and options sort of, you can go up and down the scale of correctness and formality that corresponds to difficulty in implementing and cost to implement, right? And things that are less difficult and less formal and not necessarily bad. All right, so here's your inventory options. These are complex, and so we're going to spend time with them today. This is the short, sweet version of what we're going to get at today, okay? You can adopt this NIMS tax accounting method. It is the simplest, most straightforward, most recommended method for you to adopt, and you just need to know, if nothing else, to say those magic words when you go to your tax preparer. That turns the key to all your other options. If you adopt NIMS for tax purposes, then everything else you do is okay by the IRS. If you somehow don't adopt NIMS, then whatever else you're doing becomes what you're doing for tax purposes, and any number of things can go wrong with that. So NIMS is like your safety net. Think of it that way, right? Once you hit that bell, then you're off the hook with the IRS, and then we can focus on your business and what's best for you without worrying about your taxes being wrong. So then your choices within adopting NIM are to keep your inventory on your books or to not keep your inventory on your books. And that's a internal decision about your capacity and your needs. And Olivia and I can go back and forwards with you about advantages and disadvantages of both, right? But it really just depends on you and your capacity and your needs. Two other options. There's this thing called an AFS inventory. That is an option if you already have a CPA preparing financial statements for you. And some of you may be at that scale where you're already looking at getting into regional or national distribution and taking on large lines of credit, and a CPA prepared financial statement is required. And in that case, I'm glad you're here and I hope you participate. But probably, by definition, you're already in good professional hands to do that financial statement and to make those choices. And the final option is, I'm not sure what to call this option. I'm still looking for the right phrase, but it's like it's sort of a gotcha. It's not really a gotcha. It's not a great choice. It's a choice like a candy bar, right? It'll give you a sugar high, but it'll leave you later with all the bad effects of that sugar, right? And so it's set up to be easy and tempting, and what could possibly be wrong with candy? We give it to children. That must be good, right? And then the after effects are, oh, maybe we shouldn't give so much candy to children. Maybe sugar isn't so good. So I put it out here because I can't ignore it, because it is a thing. But I am going to, frame it for you as to why you might be cautious. I guess the other way I think about this non-AFS method is, it's a drug that you see advertised on TV, and it tells you that it might make you pain-free and thin and beautiful or suicidal with cancer. And so you should talk to your doctor about whether or not you want this drug, right? So I would say the same thing for this non-AFS. Like, it does have some very potent potential applications, but I really, really hope you wouldn't choose it without the professional guidance of someone who's really helping you manage your financial systems as a whole, the way you wouldn't want to just use a drug without a doctor looking at your physical health as a whole. All right, that was the whole presentation in 2 slides. So everything else now is just that, a little bit slower, with a little bit more room for conversation. We've got plenty of time, so if you want to interrupt as we go with clarifying questions, please go ahead. And then I won't take too long with this, and when we get to the end, we can really dive into what does this all mean. So again, on financial accounting, formally that means CPA prepared financial statements. If they're not prepared by a CPA or attested to by a CPA, they can be prepared in that same manner, but they lack that sort of official seal of approval from the objective licensed outsider who supposedly speaks only the truth about how they're prepared. What supports financial accounting are the books. And what does the books mean? It used to be books, right? And then it became what was called a general ledger system. And that was literally binders of paper with rows and columns on it. And now it's your accounting software, right? And your accounting software means the books or the general ledger system, and all those old binders of paper with columns and rows has been programmed into the computer. What's programmed in is a double entry method of accounting. The reason I'm getting this basic and saying this is because when we flash forward to some of the things that Miriam and Olivia talked about last week, they were talking about degrees of integration between your inventory system and your books. And one of the things that came up was people talking about their point of sale system and their Square, their payment system. And they were focusing on integrating their sales and their payments with their inventory. Okay, so that's only part of the inventory equation. The other part is the cost value of that inventory. Because we have such potent computer capacity now, you have a lot of options where you can have a computer function that seems very high functioning, but it's actually only addressing one side of the accounting equation in your books. And that can get you in a lot of trouble and a lot of confusion. And it's very common that people adopt a system that's they're only using it for sales and receivables. And they think they've got a really slick accounting system because the sales and receivables unit that they're using is working so well. But a true double entry accounting system, by definition, by mathematical definition, produces a full balance sheet and a full income statement. It's a full chart of accounts for the full business, and every single transaction that goes through it, whether you understand it or not, affects that full balance sheet and income statement. So we can come back to this, but that's why I pause here and start you thinking about if you're using some of these powerful computer tools as a fractional system, and if you have another system that's your full system, that's fine. We just need to be thoughtful about the degree of integration. All right, tax accounting. Not recognized as GAAP. It's its own thing. Some people keep their books, their general ledger, their QuickBooks, or Peachtree or Sage, whatever their bookkeeping system is. They keep their regular books on what's called the tax basis of accounting. It's actually extremely common for small businesses to keep their books on the tax basis of accounting because they don't need formal outside CPA prepared financial statements. Most of the things that they do, they're thinking about tax. Their management things, we're going to get to that. Their managerial accounting they do on the side. And so the simplest, most cost-effective, most straightforward thing for them to do is just record their transactions on the tax basis, which only affects a few things, usually asset depreciation, and they just keep that recorded on their books, and that's their accounting method. There is nothing wrong with that at all, and there's no difficulty going from a tax method of accounting to the formal CPA prepared financial statements. Any CPA who you would hire to prepare financial statements for you, by definition, would be able to easily go from a tax method of accounting to a financial statement method. So this is language for you. It's just language. If you're having a conversation with your CPA or business advisor about how you're going to keep your books as you bring this inventory system online, keeping your book from the tax method of accounting is a perfectly good and perfectly normal option. Between tax and financial, there's a series of book tax adjustments. These are not keeping two books. This is keeping a list of the formal differences between financial accounting and tax accounting. So we don't need to go deep on this. I just want to give you this assurance and this language so you can be comfortable with it. And ideally, if you have a conversation with the CPA, you can come to that conversation already somewhat comfortable with this language. Book tax adjustments are the cheat sheet list that shows you how your book financials numbers compare to your tax numbers. Each item has its own recorded entry that explains that difference. Here we now arrive at managerial accounting, which is what you are here for. Okay. This is where you want to bring your inventory system online. Managerial accounting is primarily cost accounting. Cost accounting is inventory accounting. Those are just the same thing. Cost accounting has a few more aspects to it, but inventory accounting and cost accounting often very synonymous. The other thing that managerial accounting is concerned with is cash flow. Hope you've all figured out for yourselves by now that inventory is a cash flow problem, right? You've spent the cash to create the inventory that you haven't received the cash back in the form of sale yet. That inventory, by definition, represents cash you've spent that you have not received. And that's why we're trying so hard to manage it, because it's at the heart of the cash flow issues of the business. The managerial accounting is also concerned with finance, because finance is the other way you deal with the cash flow problem. Right? You either accelerate your sales or you get some sort of credit, or you have all the money that you need and you never have any problems and life is perfect. But you're probably not in this webinar if that's the case, right? So last points about managerial accounting. You don't keep your books on a managerial accounting method. That's not a thing. That's not a sentence you would say. It would sound weird if you said it, okay? And if you do managerial accounting, that doesn't mean you're doing your books. So bookkeeping and managerial accounting are two different things. Typically, the bookkeeper does the bookkeeping and is a little bit shocked and disconcerted if you start asking the bookkeeper to do things that are much more in the realm of cost and managerial accounting. Now, many bookkeepers have those advanced skills, but more commonly, you would have a bookkeeper who's really just focused on recording transactions, and that's bookkeeping. And then a different person that's maybe more called an accountant who helps you with things like inventory and cash flow and these more analytical and strategic decisions.
Bobby, can I just jump in here for 1 second?
So,
I would say,
please.
you know, just in terms of language, I think also, you know, the language that we use is financial analysis. Like that's what managerial accounting is, you know, is the deeper look into metrics and inputs and outputs in a way that is informed by your bookkeeping and based on numbers that you're pulling out of your accounting system, but is just your world of analysis, just to make that term feel less scary, because I think everybody has their own way they think of the word accounting. Usually we think of it like something that we don't understand, mostly. So you do understand it. Your chicken scratch on the back of a Post-it note or a napkin at a bar, that's managerial accounting. You do it. It's cool.
Yeah, I mean, to play on that, I think where you use the more formal language is when you start to adopt formal systems for your managerial accounting, right? So as
Sure.
you move from the chicken scratch on the envelope, which is managerial accounting, right? As you move from that to like buying a whole other system that's going to do inventory management for you, which is also managerial accounting,
Right.
then that more formal methodology sort of kicks in. So here's another synthesis of this. Financial accounting looks backward at what you did. That's the key thing to think about that financial accounting. It looks backwards and it has formal rules. Tax accounting also looks backwards. It's not concerned with the future. The IRS wants the money based on what you did before. And it follows IRS regulations, so your opinion is not particularly welcome, right? You got to do what you got to do. You can plan, but once you've done planning, you got to follow the rules. Managerial accounting only looks back in order to look forward. It's not that interested in the past. It's only interested in the past for purposes of thinking strategically about the future. That's a big difference. And that's, you know, and where I'm going to go now is there's lots of ways that you can record your inventory in the past to satisfy financial and tax accounting reasons, right? But the managerial accounting system you want to bring on for your inventory has a lot to do with the future. Like Olivia was saying in the webinar last week, you can't really be doing sales if you don't know what inventory you have to sell. And if you get that wrong, right, and you start promising sales for inventory you can't deliver, you've made some serious mistakes. So the inventory system allows you to look forward and manage your inventory and your sales in the future, which is where you really live as a manager. Good? Y'all still with me here? All right, so this is my synthesis of your options. I tried to do this like prizes you win in one of those Tincani publications. So best, easiest method overall winner for the year is adopt the NIMS for tax accounting purposes, and I'm going to give you a template for how to do that. Keep your books on the tax basis. This is very common for small businesses, very simple, very cost effective. And then manage your inventory outside of your bookkeeping system, which is not ideal, but this is the best overall method. Most generic, best all-purpose recommendation I can give to you. Best, most correct method overall. Not best easiest, best most correct. Adopt NIMS for tax accounting purposes and adopt your managerial method as your book method, right? So that's full integration between your inventory system and your book system. And then tax is on its own doing NIM. The only difference between these two is the integration or not. And that's the key decision I want to workshop with you today. The best tax method that isn't bad for management is NIM. The best tax method that is terrible for management is this sugar high one, drug that may make you happy or may kill you, right? That's this non-AFS method. We can talk about it later, but it's a double-edged sword. The best option for best management is to adopt a managerial accounting method, have a plan to integrate it into your books for financial accounting purposes, a plan. Doesn't mean you do it all, right? And continue with your properly elected inventory method, which is either NIMS or another method. That's your plan overall.
So,
a very good option for totally, let me just finish this line.
yeah, go ahead, Poppy. Yeah, go for it.
The very good option for totally adequate management is to adopt a managerial accounting method. Do not go to great effort to integrate it into your book. And continue with your properly elected inventory method for tax. So the difference between the best option for best management is all the bells, all the whistles, all the things, all the capacity. If you adopt the managerial accounting method and you have a plan to fully integrate it into your book, which will take you some time, and you continue for tax purposes correctly. It's not so hard and it's not so good, but it's really just fine option is to adopt the managerial accounting method. Don't go overboard on integration with your books because you don't have good reason to, and it's quite expensive to do so, and to continue your taxes under the properly elected method. Go ahead, Olivia.
I feel like there's a question in the chat that I feel like is pertinent for right now, but you decide, Poppy. And I think it just needs clarification from Julian George asking if we already work with a CPA and a bookkeeper, we don't have the options to do NIMS.
If your CPA is preparing your financial statements, then you want to ask your CPA, have we had, CPA, hey, have we had this conversation? Are you using NIMS method on my tax return? And thank you if we are. And but I guess we missed the part where you explained it to me. Or are we using some other method? In which case we really missed the part where we talked about it. And let's talk about it now and figure out what that means.
Julian George, does that answer your question? Feel free to unmute yourself or yes, thanks. Okay, cool.
All right, so the worst option, we've all said this now, Olivia and Miriam said it in beautiful three-part harmony last week. The worst option, and the one that I'm jumping in here saying we've got to really make sure nobody does this, right, is to get motivated, start keeping inventory because you just decided that was your New Year's resolution, but you don't have an overall plan. You integrate it with your books because that seems like the right thing to do, and people say that's a good thing to do, so you just go ahead and integrate it. And you file your taxes based on what's on your books because it never occurred to you to have a conversation about inventory with your accountant. They never asked. They seemed happy. You seemed happy. There you are. You have adopted a managerial method for tax purposes, and it may be wrong, and you may have to change it, and you may find that it's difficult and burdensome down the road. So there's no reason for any of you now, having been through these three classes, there's no reason for any of you to be in this worst option scenario. Part of why we present these classes is because we don't want any of you to be in this worst option scenario. And, we worry about people who stumble into this, and that's why we're here to give you these tools so you won't stumble into it. All right, just a little bit more before I shut up. So I've said this a few times, NIMS is your safety wrap. Once you hit the NIMS method, you can do whatever you want, and the IRS will basically you're good for the IRS for inventory. Here's the template. Hopefully this works. Is my screen sharing working the way it's supposed to, and you're now seeing
Yeah, it's looking good, looking good.
Great.
We'll just hit,
So you-
well, no, this is fine. Maybe let's just zoom in a little, Poppy. We can see your whole browser window, but it's totally fine. Just zoom in a little. Does this look cool for everybody else? Yeah, or everybody just make your windows bigger.
Hold on, I can zoom.
Yeah, that's
That's
good.
better,
That's
huh?
that's probably good for everybody.
I don't want to go too big and cut things off.
Yeah, no.
I forget I have a wide screen and not everybody has a wide screen, so I apologize for that. So this is the template. You'll get this immediately, I guess. It's programmed, so you're just going to enter where the cells are colored. The gray is all formulas, so you actually start entering on the second sheet. But this is the inventory formula for NIMS and the journal entries that you would need to record your NIMS entry on your book. And we can come back to this. I don't need to do a deep dive now. I just want you to know that you'll have this tool. But what you're going to do is enter your inventory count, your physical count here, physical count numbers. And then you go down here and enter all your supplies inventory. The only inventory you need to track in NIMS is supplies. You don't need to count labor, which is why it's not a good overall inventory method, because labor is obviously a huge cost. But you're just going to enter your supplies, expenses, invoices, and get a dollar amount. And this will, if you enter the units and the dollars, this will calculate the average per unit price for you. If you enter the units up here, it'll automatically calculate the price for you. And then if you roll to the front sheet, it automatically calculates based on your beginning and ending count what your cost of goods sold should be. And then here's the entries that you would make to take your supplies out of supplies expense, put them on your inventory sheet, and then take your cost of goods sold out of inventory and expense them on your income statement. So I don't need to rush over this too much. I'd rather just go back to it later when we get into the Q&A if you have questions about how to use it. My back, yes. So just the other options, this is more getting to where Olivia and Miriam were last week. This is the formal full inventory equation in a summarized form. And as they were talking about, you would actually have this full formal equation for raw materials inventory, work in process inventory, and finished good inventory. So it's actually this times 3 is your full formal inventory. What's significant about the full inventory method is that unlike NIMS, it's not just supplies, it's supplies and labor, which should be obvious that labor is important, and allocated overhead. You're running expensive machinery and you don't take some portion of that machinery's cost into consideration, you're not fully valuing the cost to create that inventory. So that's the allocated overhead, not required for tax purposes, but if you just think for management purposes, costing purposes, makes sense that you would include it. And then the cost of goods sold and ending inventory is straight up math. The part that gets hard is which cost. Actual cost, each unit you track exactly. And with these modern powerful inventory systems, they tend to be more and more geared to that exactitude, where each item has its exact cost and it goes in with its exact cost and it comes out with its exact cost. Prior to that kind of computer power, nobody ever did exact costs on anything other than really, really big, complex items. Everything was sort of averaged out, and then you would either use this first in, first out method, the first units in or the first units out, or the less usual last units in, first units out for cost. Or what I did in the template I gave you, which is really the simple bulk method, you just do an average of your costs, and everything has an average blended cost. If you ponder this for a few minutes, and we can do more again in the Q&A, these are assumptions. right? The only thing that's true reality is that actual cost method, but that's super time consuming. Everything else is an assumption. So what you might take from that is that any inventory method that you adopt that's workable is a good estimate of reality. If you're after 100% accuracy, you're probably thinking about spending a lot of time and effort for a level of perfection that isn't really that useful and certainly not worth energy that you would go to get that A++ in accounting and make it extra perfect. Because you're running a business and you're just trying to get enough information to give you the guidelines you need to manage your business. And that's not necessarily choosing the most complex and most theoretically accurate method. Other question that kept coming up that you have to figure into your system. Perpetual inventory means you're counting everything in real time. This is these point of sale systems that can automatically deduct inventory as you sell it, right? You're selling at the farmer's market, the charge goes through on Square, and it can automatically remove that item from inventory. Sounds slick, sounds wonderful, sounds awesome. Separate sounds like a lot of room for error, and it aspires to perfection, and then it falls into the human error realm. So perpetual inventory, typically that's going to be a large system, lots of money, lots of accounting staff, bigger company. Monthly or quarterly is going to be more of a mid-scale business that's going to be reconciling and doing these inventory adjustments monthly or quarterly. And then annual is where most people live. Once a year, they do the adjustments to true up their managerial accounting on the side, right? They're keeping inventory. Olivia's going to jump in and support this, right? They're keeping inventory all the time. They're going into the cooler all the time, like Olivia was recommended. They only go sit with those numbers and reconcile them to the books, either quarterly or annually. But this is a key decision that you have to make sort of early on in your overall strategy. What am I going to do next? Based on these 3 classes that I took, what actions am I going to take? Designing my new inventory system that I want. How often you reconcile your accounting to your physical count is a key decision that will sort of lay the foundation for what your accounting system and inventory system look like. If you do this year-end count, it's typically December 31st, if that's your year-end. If you have a fiscal year-end, it would be that day. If you can't do it on that day, because people don't want to work on New Year's Eve, you can do it before or after, as long as there's no transactions between when you do it and December 31st. All right, so one method is you keep your inventory and you don't do any book adjustments. Your inventory lives over here, your books live over here, books are on the tax basis, inventory is what works for you. I bless you. Olivia and Miriam will push you a little harder, right? They'll push you to think about if maybe you want more. And I'm going to say, as long as you're at least here, you're going to be square with the IRS and not underperforming as far as I'm concerned. But yes, of course, you could always aspire to more. The programs you would adopt, these are the things that Olivia and Miriam went through in detail on last week. These are systems that are going to focus on tracking the items as they move through the process, which is so important, right? They're going to focus on the yields and the units, which is information you need. They may be applying the cost layers as you go, but that's where it gets more difficult, right? And that's where you start to question, is this integrating with my accounting system or not? That's the big decision there, right? They may be automatically reducing your inventory count, but are they hitting your books as well? We don't know. That's the decision you have to make. They may be reducing the inventory to, they may be reducing the value, right? So this is the point here, units and value, units and value. Right? So they're for sure going to be showing you units have left. Question is whether or not they're also showing you the dollars associated with that flowing through to your book. That's the critical junction. So my point is they don't need to be fully in sync, but you kind of need to understand what is in sync and what isn't in sync. And as long as that's rational and you understand it and you're pretty clear what's in sync and what isn't, and you have a plan to sync them up at least at year end for purposes of closing your books, there's nothing wrong with that, especially if you are not aspiring to become a manufacturer in regional or national distribution. Right? If you're on that path where you know your goal is to hit regional and national distribution and you're going to be a multi-million-dollar company, then yeah, you should absolutely now be integrating your accounting and inventory system. Of course, you will have to go there. But if you know that you would rather dive and do that, and you're perfectly happy at the farmer's market and doing direct sales, and you just want better systems for that, and that is your growth potential, then I think there's more options, more flexibility for how much you have to invest in getting your accounting system right. So there is this option of a units-only method. This is not what's advised, but you know, if some of you say, look, I am who I am, it is what it is, and I need the simplest thing you got. Give me the simplest thing you got, because that sounds hard enough. And I would say, fine, there is this units-only method. You just track the units, you don't track the dollars, you just keep your books like you keep your books and ignore inventory for book purposes. And over on the side, you just track the units, not the dollars. I see Olivia's sad face. She wants more for you. That's okay, but but there's always reasons why more is not the best thing for this person on this day, right? So
I'm actually fine with this, especially for folks starting out.
Okay.
I want them to know what's in the freezer, and I don't want the freezer to lose power and them to not know what they lost. So it's cool, and then come back in a couple of years when you get a little bit more mature and you're like, I have no idea what that freezer cost me, or you want to make an insurance claim, then you need to know.
Thank you for saying insurance. I've been trying to get to insurance for 3 classes now. Let's be sure we get to insurance, because that really doesn't fit with tax, but it's so important. So important. Okay. Oh, good. Here we are. That was it. That was my presentation. I'm going to stop sharing. So here's the discussion. How do you know which method is right for you? Forget everybody else on the whole planet, besides the people you work with. What is the right method for you?
I think I can kick us off with a question for you, Poppy, that gets us going in that direction. A couple of different sort of prompts. One is like, what if we decide in this, as a result of these conversations, we being me, hypothetical producer, we have this interesting discussion right now, we leave going down our path, and then we go to our tax accountant or our CPA or both, and we say, hey, I've got this new information, I'm still shaky on it, but I'm thinking that this is how it's going to go. And they say, oh, I don't know about that. Like, I don't have any idea what you're talking about. And that's not anything that I do. I mean, sure, if they say, don't worry about it, you can also turn a blind eye and be like, okay, let's just not worry about it. He's not worried about it. I'm not worried about it. But I feel like this is the triage that we need to know how to navigate, because I doubt that a number of the tax accountants that at least my firmers work with, I doubt they know
Thank you.
some of this stuff. Right?
Yeah, no, fabulous. Yeah, super important, Olivia. Thank you. Yes, that is a reality that unfortunately some of you will leave this program unhappy, not because we made you happy, but because you now have this problem, that you've now understood that you're not having the right conversations with your CPA or tax preparer, and they don't want to have a specialized practice. They are in a really general practice. So I'll just give you a medical analogy again, right? The difference between an all-purpose general practitioner and you have some weird inner ear problem and you need to go to an audiologist. And that audiologist may decide that you need to go to a different specialist who's an even more specialized ear expert, right? So you may have left the realm of the all-purpose accountant that just does easy, simple, generic books for people. And you may need to go to a larger accounting firm that has larger staff and the capacity to have people on their staff who have this kind of expertise. There is no such thing as an accounting firm who has manufacturing clients who doesn't understand these inventory issues. But there's absolutely such thing as an accounting firm that doesn't have any manufacturing clients. Right? So you may be with an accounting firm that doesn't have any agricultural clients or any manufacturing clients. That firm is probably no longer the appropriate firm for you. If they're good professionals, which their license says they're obligated to be, they should be able to refer you to sort of the next size up in your community. In the sense, the equivalent of your doctor referring you to a specialist. And you're going to pay more at that point. So part of the warning we do here is understanding the cost of scaling, right? Everybody is quick on the front end to say, farmers got to go out and do value added and capture all that value. And I'm always running behind like, kind of costly to do that, right? The farmers that just have the simple method, they also don't have a lot of headaches. They get that low price, but they also don't have to spend as much time with their accountant figuring out this kind of crazy complexity. So, I'm not saying your choice is a good, bad, one way or the other. I'm just, when you get to this juncture, you probably can't continue with you cannot continue down the inventory path with a CPA who doesn't know inventory, kind of by definition. And then I'll just reference back the wine industry because people always say, how do I find the right CPA? And I'm saying, well, there's a winery in every state. So go find the closest winery and ask them who their accountant is. And probably that accountant has some clue because if they've done the wine half right, they'll be able to do the meat half right.
Yeah, and I'd also say don't be afraid of your conventional colleagues in this instance. Like for those of you that I don't know everybody on this webinar right now, but there's a lot of cattle people in this country and the decent sized outfits have CPAs that are still external and they have tax accountants. Who are they working with? Because cattle is definitely the most confusing of this. I wouldn't expect they're going to really help you on the inside of choosing a managerial accounting method, choosing an inventory system that works for you. That's why you're in these webinars, right? But they're going to get it right on the, in terms of the IRS, I'd say, and maybe set you on the right path for some at home style managerial accounting analysis, doing stuff. That would be my hope. I want to make sure that folks don't feel too shy to just turn off their microphone and ask whatever. And also, I just want you guys to all know that after Poppy's first I almost just said performance. I spent like 45 minutes decompressing with out loud noises in my kitchen with my family, like, I'm just still absorbing all of that. And this is what I do for a living. I mean, I'm not a tax and accounting specialist. I dabble in some of these worlds, right? And so it's okay if everybody's overwhelmed. And if you need to make loud noises before you ask your question, that's fine too. And there's no dumb questions, but we're here. We have another half hour. So utilize Poppy, who I think you can tell is very accessible, to ask the questions of like, okay, what do I do next? Here's my scenario. Like, I would love for somebody to say, this is what I'm doing. What do I do next? Like, because I want to go back to that worst option slide, because my guess is that many people are doing that worst option slide. So like, what do I do next? What's the next thing I do?
I'll jump in, Olivia and Poppy.
Thank you, Heather.
Yeah. So we just separated our meat business as an LLC last year. So I have a chance to like do this all right. And I need to start doing my inventory right because I actually had a freezer failure in the fall, Olivia. And I was kind of like, I think I lost roughly 200 pounds of ground beef, but I don't really know. So this is certainly good timing. And after our first 2 workshops, I did reach out to my tax advisor, CPA, and he said, let's do NIMS. So I'm very pleased that you gave us that template today. And I'm kind of wondering how that intersects with the inventory template that Olivia gave us, because I started entering my inventory yesterday. And what I had a really hard time coming up with was the cost of goods sold, because it looked like for your inventory, Olivia, you had like a different cost of goods sold for each part of the animal. And so like a steak was different from the ground beef was different from, and I don't know how to come up with those. And then when you were using your sheet, Poppy, it looks like maybe there's a blanket cost of goods for my whole beef. And so if you could like revisit your template, Poppy, and let's like figure out how I can work that in with Olivia's template, that would be awesome.
So close, so perfect setup, but it's simpler than that. You don't have to integrate them, right? So what you're going to do, this is how I translate what you said back to the options on the slides. So you'll have those slides to reference, right? What you're going to do is you're going to sit with your CPA, and your CPA already said, we're going to do NIMS for tax. We know that. Then you might say to your CPA, I think I'm planning on getting a $17 million line of credit soon. And so I figure the bank will want audited financial statements. So we better adopt a really GAAP method of book accounting. You can tell from your face that you're not planning on getting a $17 million line of credit. So you may not ever need audited financial statements, right? So you and your CPA will probably decide you're going to keep your books on the tax basis of accounting. So NIMS for tax and NIMS for books. Welcome to Olivia's worksheet. It lives on the side. You don't need to do a journal entry to incorporate her numbers into your books. And if you try, you're gonna mess up your books because you just finished deciding with your accountant that your books are on the tax basis, which is NIM, which is my worksheet. So your inventory numbers for units and for dollars live on the side. And that will support you for an insurance claim. It will. You're going to be able to show your insurance people. You keep your books on the tax basis. You report inventory on the NIMS method, tax and books. And here's your detailed records showing the cost basis for inventory purposes on the side for your inventory, and that's what's being insured. That is not weird, and it is not beyond what the insurance people can handle. And you can certainly have your CPA also add their license and their credibility to that equation in working with the insurance company to get the right amount of insurance and to understand that you're insured properly for that method. But for a small business, there's nothing wrong with that method.
I want to answer the question, the piece of the question about how we get to that cost in my worksheet, Heather, in 1 second, but I want to push Poppy one step further and say, okay, but what if Heather comes back and says, I don't want to do NIMS for my books. I want my books to be more complex. I don't want my books just to reflect my taxes. I want my books to give me all the information about everything that I'm doing in life. That's how I'm already running my books, which is also probably the scenario for most of our folks. So I think it's important, especially for people that are just starting out, to remember that you can have other methods of keeping track of your business ins and outs and keep your books just reflective of, tax accounting. But those of you that are already running your business, you're probably already running books with all of the other information that you want out of your business. So NIMS for tax.
Management for books.
Management for books. And so, and then we'll get into how you determine that cost, Heather. in a minute.
Those are the two options. Those are the two preferred options right there. Okay. So if you do the second option, you don't use my template, right? Your CPA does that for tax. You don't need my template, right? If you do management for books, you need Olivia's template, and you make those journal entries to your book. And you don't worry about tax because that's what your tax accountant does at the end of the year. You worry about whether you want to make Olivia's journal entry monthly or quarterly, and your methodology for doing that. And you keep your books on your managerial, your books and your managerial method merge. Your books adopt that managerial method as your book method.
So what that means in real life, Heather, is that remember your cost is based on either the money you paid in for already harvested meat that you're reselling, or if you're raising your own animals, the cost of the carcass. The cost of the carcass is based on the cost of your production. All of the layers that go into your cost of production is something that you're also tracking elsewhere. So if you recall from this, we touched on it in the webinar, but how we touched on it, as I said, go back to the SWGLA site and watch the 3 workshops on cost of production on how to calculate that. But it is the cost of your animal. It's the cost of what it takes to raise your animal, plus the cost that it takes to process it, right? Plus the cost that it takes to put a label and put it in a cryo bag for that unit, right? So those are all of the layers that we calculate in another spreadsheet, in another world, that we calculate cost of production to get to a carcass. And then we add in other layers of cost to get to a pack of meat. And then we port those numbers into that little chart, which is why it's so simple, because we've got 2 other spreadsheets working to get us to that unit cost. And the reason that in that example, pounds of meat are different prices is, first of all, there's all different species in that example. But the yield and margin calculator, to do the plug for the next the next webinar, will help you really calculate a per cut COGS based on an animal to animal harvest record keeping method. And yes, most of the time, all of the cuts that are coming off of your animal are going to be valued the same unless they have extra processing attached to them, like a value added product. So if there's another layer of cost specific to just a cut, like a belly, like a short rib that you marinate, then there is another layer of cost, and that cut will be worth something more. Obviously, you have more costs in it. You're paying the processor more to make the bacon. You're paying for the extra cardboard back that goes into the roll stock machine to make the bacon packaging that's different than your ground beef chub. So you have different costs for certain cuts that are processed into value added. But in theory, yes, you have a 1 pound of beef from each carcass, on one carcass. 1 pound of beef, wherever it's from, is worth the same amount. What our yield and margin calculator does, which I'm just giving a teeny preview here, is remembering you to calculate that cost not on hanging weight, because hanging weight is not what you get back if you get your beef cut out. If you get a carcass on a rail and you stick it in your freezer or your cooler, yes, you got it all back, and you can call the hot carcass weight what you actually receive and what you need to go sell. If you're processing it any further, you have loss. You have shrinkage, you have cooler loss, and you have loss to the cutting room floor. And so we calculate that cost for you per cut based on actual sellable meat. And that includes bones and fat, because that is sellable product. And we want you to remember that, because it is sitting in your freezer usually. And if it's not in your freezer and it's at the processors, then it's money you left at on the table. So that's how we get to, I encourage you guys to go watch cost of production, because there's some tools that will actually help you calculate it, even if you're growing all of your own feed and not doing any supplemental feed, for example, starting with like your hay operation. And then now I want to throw it back to Poppy and say, okay, Heather's got her cute cost of goods sold per pound. let's just remind her, because we didn't get too much into it in our inventory presentation, what's that journal entry, right? What's the double side transaction?
Double entry.
She's gonna do
Yeah.
double entry. Thank
So
you.
you still have, yeah. What you have to do, Heather, is, I mean, it's very complex. Any way you cut it, you have these multi-tab worksheets, right? So once you've calculated cost of goods sold for all the different items in inventory, then you add up all the different cost of goods sold, right? So you might have 20 different cost of goods sold. You add those 20 items, that's your total cost of goods sold. And you go to your inventory equation, which I've given you a few times, right? So you have to have confidence in your beginning inventory number, and that is units times price, right? And then you have to do your ending count, units times price. Beginning inventory, you add supplies or work in process inventory, right? New inventory coming in. You know that, right? You know what you bought, you know what's new into work in process. So you add that in, and then you plug its cost of goods sold, the difference. And you're crossing your fingers hard, making little whatever you do, right? When you plug in and you see if the counted cost of goods sold number that you calculated equals the number that you need it to be to make beginning inventory plus sales minus cost of goods sold equals ending inventory. Spoiler alert, they won't match. Right? They just won't. And that difference is shrinkage, waste. You know, different industries have different fly names for what they call it, but it's we don't know where it went, but we know it's not here. And you monitor that number. In a bigger system, like you have a pretty much a set percentage of stuff that isn't there anymore, even though when you calculate it two different ways. When you calculate what you're keeping track of your sales over here, and then what's there at the end, and you do the math, you're always off by 1.5%. Okay, so 1.5% is your standard. We just accept that. If it jumps up to 2.7% one month, you might want to go talk to your new employees. Right?
And that's why we're also keeping track of the ins and outs, like physically, you know, it could be that 3 chickens went to somebody's dinner and they just didn't get written down. And so your beginning and ending inventory, the difference doesn't match, you know, your beginning inventory less your sales because you forgot to write down that somebody took them for some other reason. So it's a check and balance there too. But I think the basic thing to remember is that inside of your accounting system, COGS and inventory are the accounts that talk to each other, right? So that value is either going into inventory from the outside world or coming out of inventory off your balance sheet onto your income statement as a cost of goods sold because you used that product for your sales. And that is the pathway, right? In your accounting system. It comes out of your inventory to marketing if you send out some samples. It comes out of inventory into meals if you serve your team some dinner. And you want to remember to do that because otherwise it's going to get booked to COGS and you're going to have a higher cost of goods sold margin because you're forgetting to record how much you're eating, which you can record in your books as a separate expense, as a separate deductible expense. So yeah. Does that help, Heather? I know it's hard without actually like going into QuickBooks and saying, okay, here's an accounting lesson, you know, but it's hard to do accounting visually.
Well, that's the thing. It takes an accounting lesson, but I want to make one more point here, Heather, that might help you. There's 2 ways you get these numbers on your books. One is this sort of perpetual inventory system, which most bookkeeping programs are trying to convince you is good and right and easy, right? And this would be full integration. Every time you add to inventory, it automatically adds to inventory. And every time you sell, it automatically deducts cost of goods sold. And every time you go into your books, they're just correct. Okay? No seasoned accountant believes that happens, but that's sort of what you're sold when you're sold these inventory things through QuickBooks. Okay? The other way you do it, which is what we're really talking about, is you ignore all of that nonsense and you only make the entry with a journal entry. And you only make that journal entry at a regular period, such as the end of the month or the end of the quarter. And you only make that journal entry after you've calculated it two ways. The two ways are, you did your running cost of goods sold calculation of what you know you sold, and then you do your ending inventory count, and you do the math to see if the number's the same or not, and if they're not, which they won't be, if that difference is acceptable and if you can account for it. Like, oh yeah, that was the dinner. Oh yeah, that was the time we filled that bin. Yes, that difference makes sense to me. I don't have to go fire anyone. You make your journal entry, and now you move on to the next month.
So
Yeah,
is,
yeah, go ahead.
is a program like QuickBooks a good idea? I mean, I've been at this point just doing Excel spreadsheets and folders with receipts. So do I need to get QuickBooks to make this work?
Absolutely, 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 Heather. You cannot go where you're going. So Excel is not a double entry system of accounting. It is not an acceptable accounting method. It is not an acceptable bookkeeping method. The first thing you have to do, your absolute number one priority, is to set up a double entry bookkeeping system. None of this has any meaning whatsoever until you have a double entry bookkeeping system with a balance sheet and an income statement. Once you have that in place, then all these things we're talking about will make sense and have a place to go. But they have no place to go in an Excel-based system.
But that said, you have the option, since you don't have it, you still have the options right now to set up those books, like Poppy said in the first part of her answer, as based on your tax accounting method. So
well, you're going to want to set up your books, Heather. You're going to want to set up your books with a standard chart of accounts. Talk to your tax preparer about that, and get yourself trained in standard double entry accounting, and then integrate the inventory system on top of that.
Okay, so the double entry accounting is not just when you're having the CPA attest to your financial accuracy of your records. Like, this is something that everyone does, even if you're not choosing that CPA prepared statements.
Yeah. Double entry accounting is what is standard. That is the standard form of accounting. When you keep records on Excel, that's the modern equivalent of just keeping a check register, right? You're just recording your transactions as you go. That is called single entry accounting. And it is not an accounting system. It's just recording transactions. It's the opposite of bookkeeping and accounting. Formal accounting system, by definition, is a double entry. And Olivia, did I teach the accounting class this week or not?
Yes. Yep.
Because if I did, then the video is there for you to see, Heather.
It's in there.
That actually has the accounting formula and explains that and gives you some tips on how to get started with the bookkeeping system. So you have some good resources for getting started.
There's a comment. I mean, Heather, how do you feel? Can we move on? I'm sorry, I think we kind of assumed you were already in an accounting system. So apologies if we made that more arduous than it needed to be.
I'm sorry, you guys cut out. My internet's unstable. Where do I see this other instructional piece that you mentioned?
It's at the Southwest Grassfed Livestock Alliance website. So it's in there for members. So yeah, I think it's called Financial Basics. So there's a comment that I just want to address real quick in the chat that says, for pricing, I use the USDA Bison report monthly. And I just want to clarify between terminology here. So what we're talking about is actually cost, and what the USDA market reports are giving you is market price, what you're selling at. Now, Poppy, maybe this is not my area of super expertise. That price index can be it's okay. In business operations, it's a valuable index. It's a valuable measure for how you might set your pricing, the amount of money you're going to ask people for. It's only one feature, like for any of you that are invested in stocks on the market, and you get an index report of like all the different indexes, what's the blended return? It's like, it's one data point. It might be way lower than what you can get in your local market. It might be way higher than what you can get in your local market. That's price. We're talking about cost here. So the inputs that go into your animals to get you a number that tells you how much per animal, per head, per pound you actually paid to raise and cut that thing up. So that's cost. And I just wanted to make that distinction here. Now, on an insurance claim, when the freezer goes out, I don't know, and Poppy, maybe you know, what they're going to go after. Obviously, you can declare, I lost the market equivalent of the retail value of that inventory. I would have sold all of that and gotten X amount of dollars. That is ideally, absolutely has to be higher than the amount of money you put in to make that stuff that you lost, right? And so your inventory that you're keeping on the side, you need the cost number, not the retail value. But for an insurance claim, Poppy, have you had any experience with what?
It's going to depend on your insurance policy.
Right.
So the insurance policy is either going to insure you at cost, be sort of a bad thing, a minimal thing, or it'll insure you at its replacement or sales value. So that's, and you're going to pay more for insurance that gives you more.
Yeah, to replace at retail value. Yeah.
Yeah. And there's a few different places you can go for sort of more of a primer on insurance and how insurance works, but you need to understand the concept of what you're insuring, and then the percent of that you're insuring,
right? And
that theory on which they'll reimburse you, and then your deductible. So there's actually quite a bit to understand around insurance, and would be another really fabulous topic for us to cover, because it's quite technical how you go about adequately insuring your finished product. And livestock insurance and the kinds of insurances that are appropriate for livestock producers are entirely different products, entirely different insurance companies. And then the kind of insurance that you buy on a finished food inventory item, very few companies sell that kind of insurance. Very few people specialize in it, because it's very high risk and very, you have to know a lot about that tiny niche industry to be able to insure it properly. So really a whole other topic for a whole other day.
Cool. So we've got some good back and forth in the chat, but I'd love to hear some more, any questions or fears, or, where are your minds going? I wanted to go back to one point, if nobody has anything right now that they want to talk about. When Poppy was talking about the different ways to value your inventory, which units, which costs, right? And the last bullet point was weighted average cost. And I just wanted to go back to the reminder that we touched on a little bit last week, but that is, I think, inside of this sector and world, what I would recommend be used. And what that means is actually doing the calculations on that cost of production for your carcasses, right? But you also need to know that not every animal is going to cost you the same amount to raise. There are going to be variations. And you're going to get an average across a certain period of time. And I think from a livestock perspective, given with the fluctuations of feed and inputs, that I think it's safe to do that for the year and use that number for the course of your year, right? And not be trying to calculate that all the time. Now, if you are starting to resell, if you raise animals and sell meat, and then you say, oh, you know, and I could do better on my e-commerce site if I had some chickens and some pork. And so I'm going to ask my people down the road and I'm going to buy in from them. And you sell your pork alongside their pork, you've got all sorts of different inventory costs. And then you need a more complex system, hands down. And you're not doing some sort of cost evaluation once a year. And now you're a reseller and you're much more like a manufacturer in a wine company, and you know, you're doing all sorts of different things. If you're raising livestock and you're selling meat, let's get that cost of production nailed down. Let's go with a knowledge base on what your animals, all your animals are costing you across the course of the year, across even fluctuations in inputs and feed prices across that whole year. Sure, okay. Our yield and margin calculator will help you do that, because what it does is allow you to record every harvest, which we want you to do, because not every animal is going to give you the same amount either. So let's start there. And then also just from a, you know, inventory entry standpoint, where you're reconciling your physical count with your books, the slide where Poppy said monthly or quarterly or annual. Last week, we talked about monthly. I like monthly. I'm totally fine with annual. I think annual is great. And you know what I really care about is that it goes right correctly on your taxes and that you feel confident about that tax accountant. And that's what Poppy sort of told me a few years ago. Like, it's cool. Just have them not do it more often. Just tell them to give it to their tax accountant. And that's keeps things very simple. What I care about is that you're in the freezer every month, and you're in the cooler every month, and you're in your coolers every farmer's market, and you are counting all the time. And it just lives in this little world of knowing what you have on hand. And it can intersect with your books quite infrequently. All right, we've got 5 more minutes on the books here to pick Poppy's brain.
Just give you a little perspective here. If this stuff was even 50% easier, there'd already be a good module for how to do it in QuickBooks. QuickBooks is a big company, right? They have significant capacity, truly significant. I mean, they're integrated with Intuit. They're big, right? The fact that they still don't have a usable inventory module should tell you how not at all simple this is. This is just a fact. This is hard any way you cut it. And all you have to work with are 5 or 6 different sort of standardized models that people use, that they've sort of standardized to model this incredibly complex reality. And each of the models are complex. And they're just models that are simplifying them. So just understand, like, there's just no way around it. We're doing our best to give you, you know, show here. You can do it, you can do it. But it is, if it was simple, you would already have been given simple tools to do it.
So since no one's jumping in, I'm going to totally monopolize your time here.
Go for it, Heather. We can all learn from you.
So if I understand correctly, as I'm getting set up, I'm going to get QuickBooks, and that's going to help me keep track of my income and expenses. And that might help me come up with my cost of goods sold. Is that part one correct?
Stop.
No.
Stop. You're going to get QuickBooks. You're going to use the standard chart of accounts that you're going to get through Olivia and SWGLA for your livestock business. That's one company in QuickBooks for your livestock business. You're going to take your same QuickBooks that you purchased from QuickBooks, and you're going to set up a separate company called QuickBooks. You're going to use a different chart of accounts that you're going to get from a different source, because I didn't give it to you, and it's not a livestock business, manufacturing business, marketing business. Someone else will help you with that chart of account. You're going to set up that separate company. Then you're going to have to go and sit with the bookkeeper and learn how to do the transaction between the livestock company and the meat company to sell your meat to the meat company. There's lots of ways to do it. It's not that hard, but someone's going to have to show you.
So just for the
And
plug here,
that only
Bernoulli
gets-
Finance does all of this. So Miriam from last week, Bernoulli can do this for you. Lots of accounting companies can do this for you. The guy down the street can do it for you. But like we said, we also want your accountant to be able to understand agriculture. So there's lots of possibilities there.
Right. Okay. That still doesn't get you to cost of goods sold, okay? When you open up your QuickBooks and you tell it, the first thing that's going to happen, and this is why just Heather, please don't do this on your own. Whatever you do, promise me you will not do this on your own, okay? This is the ad on TV telling you to talk to your doctor, not the ad telling you to go do drugs, okay? So when you get your new QuickBooks set up, if you set it up yourself, QuickBooks is going to say, you know, what do? And you're going to say, I manufacture meat. And it's going to say, great, you're a manufacturer. And here is all the inventory system for you. And just trust us, it's going to be great. And 3 months later, you are going to be inside of just a complete disaster zone, guaranteed. Guaranteed QuickBooks lies and will be wrong. Stay away if you tell them you're a livestock business and a farm, and they give you a farm chart of accounts. That will also be disaster. They don't know the first thing about what a farm chart of accounts should look like, okay? So your second QuickBooks company, set it up with Skilled Advisor. It will not calculate your cost of goods sold. You will calculate your cost of goods sold in Excel on the side. And monthly, quarterly, or annually, you or your bookkeeper will make the journal entry that comes off the Excel and you'll put it into the QuickBooks. And that is the only realistic way for you to have your QuickBooks accurately reflect your inventory.
We have a tool for that, Heather, at SWGLA. Like that's, we have lots of tools. So just, yeah, QuickBooks. Think of it kind of like your parents, like they only really need to know what they really need to know. You know, they don't need to know like all the stuff. They do need to know some stuff. And then there's the IRS and they really only need to know some of the stuff, you know. So.
That's a good analogy, Olivia. I like that.
I mean, you can get to a place in complexity where you are ground truthing your Excel against your QuickBooks. That is absolutely true for businesses that get to a certain level of complexity inside of their QuickBooks. They do that usually with bookkeepers and CPAs running those books because it's hard, you know, where your cost of goods sold looks like what you calculated in your Excel. Yeah, that's ideal. That's what we're all kind of like hoping for. But for you, you're way far behind that, and it's okay. We just want you to set up an accounting system because at the end of the day, you're going to be able to analyze your business much better than your Excel. I mean, it's super cool that you're using Excel. Like I work with a lot of people where I'm moving from the boxes of receipts to Excel, like tons of them. It's awesome. You're in Excel. You've already taken a huge leap. You're not in the boxes. But you're going to get so much more information about your business in general, not about inventory, but lots of other stuff, just by learning how to read an income statement that your QuickBooks is going to like spit out from you, and managing customers because you're going to be able to know what they owe you, like much easier than going back and finding out. So there's a lot of efficiencies to having an accounting system, and that's how you're going to grow and evolve as a business owner by letting those numbers, you know, sort of empower you instead of scare you, I'd say. So
to give you a perspective, Steve, a friend of mine is the meat economist for a pretty large regional specialty niche meat producer in wide regional distribution, multi-million-dollar company. And I said, what's the state-of-the-art thing I need to know to present to SWGLA? And she's like, they keep their books in QuickBooks and they keep their inventory in Excel. That's all you need to know. Multi-million-dollar company. The cost of bringing online these systems that promise the sun and the moon and all this automation versus the cost of just cranking away in QuickBooks, which can easily handle a multi-million-dollar company, just not the inventory side, and Excel, which can actually pretty easily handle multi-million-dollar inventory if it's not too diverse and their product line isn't that diverse, right? And then you just do the monthly journal entries and call it good. Because what they'd pay to bring on the super satellite system, not good value. So if it's good for a multi-million-dollar company, probably you can set up a system that'll be good for you.
All right, thanks everybody.
Good luck, everyone. Stay in touch.
Bye.
Bye.